Hello everyone, in this video we will be talking about the cash flow of a company. Free cash flow or FCF is the actual cash a company has left after running its business and making necessary investments. Unlike profit, which is based on accounting rules, free cash flow represents real money that the company can use. This cash can be used to pay dividends, reduce debt, or reinvest in growth. Because of this, investors often look at free cash flow to understand a company's true financial strength. To understand free cash flow, let's look at how cash moves through a business. A company generates cash from its core operations, like selling products or services. It then spends money on daily operations, such as salaries and rent. On top of that, it also invests in long-term assets like equipment or technology. After all these expenses, whatever cash is left is called the free cash flow. You can think of it as the company's leftover cash. The formula for free cash flow is simple. We take the cash generated from operations and subtract capital expenditures, also known as CapEx. Capital expenditures are the investments a company makes in long-term assets, such as buildings, machinery, or technology. By subtracting these, we get the cash that remains after both running and growing the business. This gives us a clearer picture of the company's actual financial position. Let's look at a simple example. Suppose a company generates $5,000 in cash from its operations. It then spends $2,000 on capital expenditures, such as buying equipment. If we subtract these, we get $3,000. That $3,000 is the company's free cash flow. This is the cash the company can use freely, whether for reinvestment, paying dividends, or saving for the future. One of the most important things to understand is that profit is not the same as cash. Profit is calculated using accounting rules, which may include revenue that hasn't been received yet. On the other hand, free cash flow shows the actual cash available. A company can report high profits but still have little cash, even if it hasn't collected payments or has spent heavily on investments. That's why free cash flow gives more realistic picture of financial health. Free cash flow is important because it shows whether a company is financially strong and flexible. It tells us if the company has enough cash to pay dividends, reduce debt, or invest in future growth. Investors also use free cash flow to compare companies and to value businesses more accurately. In general, companies with a strong and consistent free cash flow are considered more stable and attractive. To sum it up, free cash flow tells us how much real cash a company has left after running and investing in its business. It is often more reliable than profit because it reflects actual money available. By looking at free cash flow, investors can better understand a company's financial strength and long-term potential. It's a key metric that helps make smarter investment decisions. Thank you.